Okay, folks, good evening. Happy Friday, TGIF. And before I start, a huge thanks for those who are here who chose to spend a Friday night with me. It's an honor, okay? It's an honor. But anyway, we have webinar every Friday lah. But this particular webinar is actually sort of more for the public also. Anyway, this video will be recorded. This session will be recorded lah. So if you are new here and if you want to access the recording and PowerPoint, right, do join our Discord. If you join our Discord channel, we will have our public area where we usually post all our videos that we specifically do for the public folks okay. But our Discord also have a lot of other private channel for subscriber and such. But anyway, even if you are in the public area, right, you will definitely find some useful stuff there okay. And you will also be announced of any future potential free webinar like this one that we are having here. So this is not the first public webinar that we did for this year. I think we did quite a number of time already. So I believe this is like our fourth webinar, okay? So without any further delay, let's begin. So the topic of today's webinar is currently the federal fund rate is at 5.5%. So what is next for the stock market? So when we look at the current stock market right now, the views are actually very polar in a sense that there are those bullish folks who think that market can go up even higher all the way to new highs. And there are also other folks who think that market is going to crash soon. We are going to be in a recession soon. So it is a bit kind of hard to make out what is going on right now. Even when we look at the current state of the economy, right, it's a bit hard to kind of determine where things are heading okay. So if you have like small business, if you are a small business owner, I'm sure you can feel the pain of the current high interest rate environment and the high inflation. And then at the same time, we see things like the recent COE going to new high, HDB selling for 1 million. So it's like as if people are poor and people are rich at the same time. So let's kind of try to dig a little bit deeper to see what's going on now. Okay, so we have Jim Cramer here, who tend to be a super duper mega bull, and then we have Michael Burry there, who tend to do a lot of big shots okay. So now, speaking of Michael Burry, let's start off with our Mr. Michael Burry first. So recently, sometime around mid-August, this article is on 16th of August, and you can see that Michael Burry actually placed $1.6 billion bet on a stock market crash, okay? 1.6 billion, start with a B, not million, okay? So if you look at his overall position, he only have two positions. One is a put option on SPY. The other one is a put option on QQQ, which is tracking the Nasdaq 100 okay. So overall, he have 90% of his entire portfolio betting on the market downturn. But so far, we are already heading into mid of September. Market is still somewhat resilient, okay. Market is still not going up. Fake one. Okay, let's continue. Yeah, so because of this Michael Burry news, right, suddenly a lot of people are feeling like, oh my god, Michael Burry betting on market crash, and like regardless whether if it is true or false, there are a lot of it invites a lot of attention, and a lot of people are looking at the stock market and sort of maybe feeling that perhaps stock market may crash okay. But anyway, we are not discussing what his portfolio is okay. Just kind of want to let you know there is this thing that happened very recently. So now, is there a reasonable ground for a very big downside? So when we take a look at the stock market, when we try to analyze the current economy, right, we have to do it in a very balanced manner. We have to see what is the bear case. The bear case meaning there will be a recession, stock market is going to crash. And then we also need to look at the bull case where everything is fine, stock market is going to go up higher. So we need to look at both sides. So let's take a look at the bear case first. So is there any reasonable case for a very big downside in the economy and the stock market itself? So if we look at the Nasdaq index right now, this is the Nasdaq 100, where we have all the tech growth stocks in this particular index. If you look at the entire of 2022, right, we have that very, very big crash. So this big crash was actually due to the interest rate. We have the very first interest rate hike in 2022 March. And then we have extremely aggressive pace in the rate hike. We got 4 rounds of 75 basis point hike, which caused the second half of the year of 2022 to crash further. But since the beginning of 2023, right, we saw the market rally up very, very close to the previous high here, okay? So the previous high was 16,754. And right now we are sitting at, currently today, 15,456. So not really that far off from the high. So we can see that even with the high interest rate environment, the stock market seems to be somewhat resilient. So it kind of go against the textbook definition of high interest rate tend to mean stock market not doing that well. So firstly, let's take a look at the federal fund rate. Federal fund rate is your interest rate, okay? So we can see how the federal fund rate have evolved over the year. But I want you to take note of a few things here. Is the gray color shaded area, okay? All this gray color shaded area. So this gray color shaded area represent period of recession, where the economy goes into recession, a lot of people lose their jobs, their home, and then stock market crash. These are the gray color areas. So we can see one in 2020, a very short period where COVID-19 hits. The last long recession was in housing market crash. And then we have the dot-com bubble. But beyond dot-com bubble, right, I don't think most of us are old enough to sort of experience the stock market crash. Maybe there are folks who are like 50, 60 who experienced the 1990 recession also, but from what I know, most of my viewers are like millennial or Gen Z, okay? So most likely we are not even born during the 1990 yet, okay? So what can we see? What relationship we can see within recession is that every time when Federal Reserve does a rate hike, when the federal fund rate goes up, interest rate goes up, right? It often follows with a recession, okay? So all the way from 1970, right? Every time we have a rate hike cycle, more often than not, we tend to have a recession. So I think from here, with only one exception during this period, every other instances, right, a rate hike lead to a recession, okay? So currently right now, the federal fund rate is even higher than the previous rate hike cycle. The previous rate hike cycle was in 2015, where we hit about 2.5% interest rate. But currently we are twice that of 2015 cycle. We are currently sitting at 5.5. So it is at the level during the pre-housing crash level, okay? But as of now, the economy is still doing quite well. Things are not heading towards recession yet. But what we can see in terms of data, right, is that there is precedent of Federal Reserve breaking the market, breaking the economy almost every rate hike cycle. So this is something that we need to be a little bit sort of concerned about, because there have not once in history, right, a rate hike cycle does not end in a recession. Okay, so current federal fund rate is at 5.5% right now, which is at the pre-housing crisis level. So now, with the federal fund rate at 5.5%, right, what I want you to take away from this slide is taken from Federal Reserve website. Their summary of economic projection. And within this document, right, it was released on the 14th of June. And you can clearly see here, right here, their federal fund rate projection for 2023 is 5.6. Currently, we are still at 5.5. So in order to hit 5.6 as per their projection, right, they need to do one more rate hike, okay? Within this year, there is one more rate hike incoming, according to them. When are they going to perform their rate hike? We don't really know. It could be in September, it could be in October, or it could be in December. Either one of the 3 sessions that is that left remaining. So with this last additional rate hike, right, there is a lot of talk about, okay, when Federal Reserve do one more rate hike, maybe it can actually break the economy. So we don't really know how is it going to be like. But what we do know is we still have one more rate hike incoming, unless Federal Reserve decide to change their decision, okay, which can happen also. So right here, what you are looking at is the chart of the 10-year US Treasury bond yield, which is currently sitting at a very, very high level of 4.32%. So if you recall, somewhere back in 2020, the 10-year yield is like less than 1%. If you go to any bank to do your fixed deposit, right, you barely get like 1%. The Singapore saving bond also giving really, really miserable rates. But right now, the yields are extremely high, okay? So this 10-year yield, right, it is important to monitor, mainly because everything that is rate sensitive, such as your mortgage rate, fixed deposit rate, credit card interest rate, your auto loan, your personal loan, whatever that involve interest rate, right, it will generally move along with the 10-year yield. So if the 10-year yield decide to go up higher, all your interest rate product will go up higher also. So currently we can see that things are still quite bad, okay? Things are still going up. So now the effect of high interest rate. So this is textbook, okay? So high interest rate and bond yield, right? Bond yield is referring to the 10-year yield. It is generally bad for the stock market and the economy. This is because it increases the cost of borrowing. The high cost of borrowing deter economic growth. And you can see this very clearly in mortgage rates right now. If you want to take a mortgage loan, right, it is costing you close to 4% right now. Where if we look back 3 years ago, it was barely like 1.5% like that. So companies with high level of debt that were taken during the low rate environment back in 2020, right, they need to start paying higher interest expenses. So companies will go into cost cutting mode instead of expansion mode, because now they have to pay so much higher interest, right? And because it will affect their profitability and earning, right? They will go into cost cutting mode where they will do things like layoff. Of course, I'm sure you all are aware of the big tech layoff that happened during the beginning of 2023. We have companies like Amazon, Microsoft, Apple, Nvidia cutting employees left and right. And stock market tend to decline as future earning and cash flow get guided down when interest rate goes up. So big companies with stable profitability, right, they will suffer much less compared to all those small growth companies that are exposed to high debt. So here I have four index here. Firstly, you have the Nasdaq 100, which I showed you earlier. And then we have the S&P 500 and Russell 2000 and ARKK. So Nasdaq 100 and S&P, they are more, their weightage is more towards the big tech companies like Apple, Microsoft. So whether or not S&P 500 or the Nasdaq 100 will do well, right, it is dependent on the performance of all these big tech companies. But if you look at Russell 2000 and ARKK, right, these two index mainly comprise of small growth company. So based on their performance that you are seeing in this chart, right, you can definitely see that the S&P 500 and the Nasdaq 100 perform better compared to the Russell 2000 and ARKK. This is simply because the small growth company, right, they are actually hurting quite bad in the current high rates environment, because Probably they are not even making any money in the first place. They are not even profitable in the first place. And now they are hit with this high interest rate, right? It will it will suffer, they will suffer worse compared to companies like Apple or Microsoft. So we can see a very, very clear relationship on why the Nasdaq 100 and the S&P 500 do better. So on a stock level, on a company level, I can give you these two examples. If you look at Tesla and Rivian, right, they are basically in the same sector. They manufacture EV, electronic vehicle. So just one look at the chart, right, you can definitely see they crashed during the 2022 interest rate hike cycle. But beginning of 2023, right, Tesla actually recovered quite significantly. Whereas Rivian, right, you can see it kind of went down further and then stagnant for a while. And then only recently it is starting to go up by a bit. But if you look at the overall performance-wise, right, you can see Tesla actually recovered a lot more compared to Rivian. But these two companies are in the same sector. So why is there such a disparity in the stock performance? This is mainly because Tesla is a very big, mature company that is bringing in a lot of cash flow and earnings, whereas Rivian is like struggling to even make profit at all. In fact, they are loss-making right now. They are not making any profits. So now, if we compare Tesla, the latest earnings, Tesla have 25 billion in sales and 2.7 billion in overall net income, and their gross margin is about 18%. If you look at Rivian, the latest earning, they only have 1.1 billion in sales, and their net income is actually negative 1.2 billion, meaning they are losing more than what they make. So it is actually, they are actually loss making. And the gross margin of Rivian is negative 42%, meaning to say that for every car they manufacture, they actually lose 42% of the value. They actually lose 42% of their cost, the materials. So you can definitely see why in a current high interest rate environment, Rivian will do very, very bad while Tesla will do a lot better, even though they are selling the same thing. They are in the same industry. So of course, Elon Musk, mainly he kind of ensured that the manufacturing power within all the Tesla factory, everything is doing well. Okay, so it is also dependent on how competitive how competent the management is. So COVID-19 actually have a lot of impact on the current economic cycle. So there are a lot of quirks that COVID-19 bring about, which wasn't present in all our previous market cycles. For example, if we look at 2008 housing market crash, right, there are definitely a lot of stuff missing, which is present in the current economic cycle. Excuse me. So firstly, right, we were hit with the COVID-19 pandemic in 2022. The entire world went into lockdown mode. There were no travel, all the airlines locked down, all the restaurant locked down, everything locked down, shopping mall locked down. And because of that, right, the interest rate was cut to zero in order to encourage economic growth, in order to encourage loans, borrowing of money. And Federal Reserve and various central banks around the world, right, they unleash unprecedented level of stimulus packages in order to boost the economy. So this caused a huge spike in inflation within a very short period of time that we have not yet seen since 1970s. So the inflation level that we are experiencing right now, right, the last time we have seen such high level is actually all the way back in 1970s. So if you are trading, if you are investing in this current environment right now, it is actually a very unique environment. And I can tell you that if you can survive from 2020 all the way until like 2030, right? If you're a trader and you can survive this market and you made it out with very big profit going into 2025, I can say that you'll probably survive any kind of market cycle. So to bring inflation down, Federal Reserve carried out one of the most aggressive rate hike in 2022, where we have 4 rounds of back-to-back 75 basis point hike. And once again, right, this level of rate hike we have not seen since housing market crisis back-to-back 75 basis point hike. So what we are seeing here is that within a very short period of time, right, we have a sudden burst of stimulus, and within the next 2 years, we have a sudden aggressive rate hike that are coming in. So we have 2 very sudden event that occurs, which we have not yet seen. So between the initial rate cut in 2020 and the start of rate hike in 2022, right, it's only 2 short years. It's very, very sudden. So what happened is that these 2 years, right, is not enough time for consumers or corporate to pivot their finances properly. So imagine back in maybe beginning of 2021, you see interest rate are at 0. So you go and buy like 2 condo, go and take up 2 mortgage loan, buy 2 condo, go and buy a car, everything on maximum debt level. If you do that, right, currently right now you are probably feeling the pain because interest rate have gone up very, very high. Your mortgage payment probably doubled already, so you'll probably be feeling the pain. And the thing is that because this happened in such a very short period of time, right, it doesn't really give all the consumers and corporate enough time to sort of deleverage, de-risk their portfolio. So as such, right, anyone who have over leverage, such as buying multiple property or hiring too many workers back in 2020, they are now facing a tough time coping with both inflation and high interest rates. So this is a double whammy, okay? You have to deal with high inflation and you also have to deal with high interest rate. Recently, I read some article on Straits Times where this 2 couple, initially they own a condo. So what happened was they decide to decouple so that the wife can buy another property and they want to hold 2 property. And then what happened was in 2022, both of them, both the husband and wife lost their job. And then now instead of having an asset, right, they are now faced with very, very big debt. I think they have to let go of both property and downgrade back to HDB. So the current rate hike cycle, right, it severely affect those who over leveraged during 2020, and there wasn't really sufficient time for them to sort of pivot. And in fact, if you over leverage buying a lot of properties in 2020, right, maybe towards the beginning of 2022, you may have that sunk cost fallacy, like, I hold don't want to let go I don't think things are so bad. But right now things are actually very, very bad. And this kind of poor planning, right, it is what this high interest rate environment kind of affect. Okay, so consumer and corporate who got greedy and poor financial planning, right, these are the folks that are hurting the most. So stock market in the current economic cycle, Nasdaq dropped about 35% and S&P dropped about 25% from their peak in 2022 due to the initial rate hike. In 2022 was the period where aggressive interest rate hike took place due to the high inflation. In 2023, stock market recovers because the big companies are still doing relatively well in a high rate environment. However, right, the recovery in the stock market is led only by a handful of companies known as the Magnificent Seven. You can go and Google the Magnificent Seven. So this Magnificent Seven, they are Apple, Microsoft, Tesla, Alphabet, Amazon, Nvidia, and Meta. So majority of the stock market recovery, right, it is only led by these 7 stocks, these 7 companies. In fact, outside of these 7 companies, right, almost everything else is doing quite bad. So these 7 stocks, right, coincidentally, they also hold the highest weightage on Nasdaq and S&P 500. So that's the reason why you see both Nasdaq and S&P 500 going up quite aggressively, because most of their heavy weightage is coming from these 7 stocks. And any index, any unit trust that doesn't have these 7 stocks, right, most likely they will be doing very bad. Just now we saw Russell 2000 and ARKK, right? The performance was quite bad. So majority of the stock outside of the M7, right, they are still doing quite poor. So Federal Reserve is determined to bring inflation back down to 2%, and they are determined to hold the rate at 5.5 to 5.75 for a significant period of time. So currently we are sitting at 5.5. They may do another 25 basis hike sometime soon. And once they hit that level, right, they are not going to immediately cut. What they will do is they will hold it at that level for maybe 1 year, 2 years. I'm not sure also. This is something very hard to predict. Even Federal Reserve themselves, they are not sure how long they want to hold. They are, from their own mouth, they are waiting to see the data. They will be data dependent. So based on the kind of economic data that they are getting every month, right, they will decide how long they want to hold. Okay, so the longer the rates are held at this level, the higher the risk of economy breaking. So eventually, right, the keyword here is eventually, this could break the economy and the stock market. So refer back to the earlier slide, there are no instances in history where Federal Reserve did not break the economy during a rate hike cycle. They always do too much and then everything falls apart. So now, we have covered the bear case, the case of a recession. But the thing is, are we really heading for a recession? Because everybody seems to be spending money, everybody flying business business seats in airline, everybody traveling, or almost every friend I know is traveling. I can't travel because I have to give webinars and I have to give courses. But as mentioned, right, COE prices going up. So are we really heading for recession? Every day I go, not every day, every time I was in MBS or Ion, right, LV, Cartier, all these shops, right, always fully packed one now. Okay, so now the US economy is still looking healthy. So we need to look at the bull case also. We have to look at both sides of the coin. We cannot be too overly lopsided in our view. So now US economy is still growing aggressively in 2023. So if you look at the US GDP growth, right, the quarterly GDP growth, you can see there was a negative growth back in 2020, quarter 1 of 2022 and quarter 2 of 2022, there was decline in the GDP growth. But immediately after that, right, you can see the economy returned back to growth. And in fact, for the last quarter, which is the quarter 2 of 2023, right, the consensus was only 1.8%. They only forecasted 1.8%, but the actual growth was 2.4%. So there was a surprise growth in the GDP. Okay, that is to say, currently US economy is still growing, and I don't think it is in the it is in the risk of any form of recession. So you may be wondering, right, okay, it's still growing, but it's only like 2%, 2.1, 2.6. But what you have to understand is that the US is achieving this level of GDP growth under 4% interest rate. Currently, it is at 5% now. During this period, it was around 3%, 4%. So they are able to achieve this level of growth under a high rate environment. And I will say relatively, it is considered very, very strong growth. And for quarter 3, 2023, currently we are in quarter 3 right now. September is the last month of quarter 3. So Q3 haven't ended yet, okay? But currently the forecast for Q3 GDP is actually 4.9%. So 4.9% is incredibly high. It's very, very aggressive in terms of growth, okay? As you saw earlier just now, we were looking at 2%, 2.1%, but for quarter 3, right, the forecast is actually 4.9%. And in fact, this is very high level of growth because quarter 3, we are looking at 5% interest rate, whereas back in quarter 1 and 2, right, the interest rate was probably 4.5 like that. So despite the very, very high interest rate, right, US GDP is still growing quite aggressively. Next, consumer spending. Of course, in order for corporate to make money, people like us need to spend the money. Okay, if we are not buying iPhone, Apple is not going to go up. If we are not buying all the gaming PC lah, what lah, then Nvidia probably won't go up. So the only reason for stock market to go up is because consumer like us are spending, and that's why if you look at even the Singapore stock market, SIA share price went up very, very high in 2023 because everybody is flying now. Okay, so consumer are still spending. If you look at this chart here, is very, very aggressive. Okay, so even in July, right, July 2023, you can see there was a excuse me, there was a bit of spike between here and here. You can see it was going up quite gradually, and then suddenly there's a sudden spike here. Okay, so despite the high rate, right, we can see consumers are still spending quite well. Of course, you probably see this if you are in Singapore. Consumer spending is still very high. Your COE price hit new high. HDB resale price climbed to 0.6, and there are more and more 1 million unit HDB being sold. So if we look back in United States, some of you may probably hear a lot of doom and gloom news about US housing sector, or that certain state in US, the housing market is crashing, this and that, right? But actually no, according to data, US housing situation is almost the same as Singapore right now. Everything is going up and there's a lot of buyers. So despite the mortgage rate at 7%, US 30-year mortgage rate is at 7% right now. Despite that, right, US housing market is still very strong. You can see every month, right, the number of new homes that are being built and sold, they have climbed very, very sharp since the end of 2022. So it does seem that the high interest rate is not really impacting the US economy for now. So current state of the US economy, consumer spending and GDP growth is still strong for US. So even in high interest rate environments, spending power of consumer is still high. So why? So anyone want to guess why? Why is US consumer spending still so strong despite all the high mortgage rate, high interest rate? Anyone? I give you 1 minute. I go and drink water. Okay lah. since it is public webinar, everybody very shy. Okay, there's actually a lot of reason why even at such a high interest rate, right, the US economy is still quite strong. This is mainly because huge amount of saving during pandemic due to the lack of travel and outdoor dining. Yes, correct. Thank you. High saving, high disposable income. Stimulus packages. So there's a lot of stimulus packages, especially in the US, especially for the small businesses. Okay, small business owner, you probably will receive quite a generous stimulus package. So I'm not because I'm PR. I'm not Singapore citizen. I didn't receive any stimulus package. My stimulus package is from the stock market lah. Okay, stock market give me profit lah. But I'm sure most of you will receive cash payout from government also straight into your DBS account. Even in US, right, most of the citizens get like $600, and then they go and spend that $600 on buying GameStop stocks during the 2020 rally. So in 2020, right, there's a lot of startup tech companies also that are giving out huge salary and bonuses. I know I have a friend who worked at particular tech startup company. very, very smart, okay. Fresh out from uni, very smart. His starting pay is 6 digit, you know. His starting pay is actually 6 digit, which is crazy amount. And imagine you have this level of salary and you can't spend it, you can't go out and eat, you can't travel, so there's a lot of disposable income now. Firstly, there's a lot of crypto GameStop millionaire also, but of course, crypto GameStop, I'm just using it as a proxy for the entire crypto market, okay? And of course, all the crazy GameStop rally, Tesla also rally like crazy, AMC also rally, so that there were a lot of young kids becoming overnight millionaires, okay? And that actually contribute quite a lot to the current economy also. And economy, right, it will only start to crack after Federal Reserve hold the high rates for a period of time. So generally, Federal Reserve will do their rate hike cycle. They will have a target that they want to hit. So currently, their target is 5.6% now, okay? And once they hit the target, right, they will hold the rate at 5.6 for a very long period of time, probably 6 months, 1 year, 2 years, 3 years, 4 years, depends on how long they want to know. And the moment they start holding it for that period, right, only then you will see cracks start to form, because by then, right, all the disposable incomes are gone, all the companies, corporates, they are not doing well, right? They start to declare bankruptcy. Of course, we already see quite a number of US companies declaring bankrupt, like Bed Bath and Beyond, declaring bankrupt. I think Carvana also was at the risk of the declaring bankruptcy also. So the cracks will only start to form after a period of time. So after a significant period of high rates, consumer savings will eventually run out, and corporate will continue to cut costs, which lead to more unemployment, which leads to more people not having sufficient money to spend, and eventually, right, the economy will crash. But currently, as of today, US economy seems to be still doing quite well. So with all this said, right, we have covered the bear case scenario, we have the bull case scenario. So what are we doing? What is Nimbus Capital doing in the current economy? So firstly, I want to make a disclaimer. We are traders. We are not investors. I personally do invest. I have a long-term portfolio, but what we discuss in our weekly webinar, what we share on our Discord channel is mainly for traders, okay? We don't really talk about investing long terms. So this is our 2023 trading performance. We start off the year with $120,000 in USD. Currently, we are sitting somewhere close to $160,000. Our net profit is about 37.5K. Year to date, ROI is about 31%. So in total, we have closed 126 trades. Each of our trades take about 17 to 28 days. So you can see we don't really hold our trades very long. We enter after like 1 month, we close out the trade already. Okay, so this is our performance, and I will say that 2023 is not really a good year for us. Normally by end of the third quarter, right, we probably have about 40-50%, but currently we are still sitting at 31%. And this is because the current environment is not easy to trade. It's very hard to determine the direction of the market. So if you are around in early 2023, if you generally look across the mainstream media, right, everybody is talking about recession. Everybody is talking about stock market crash. But what happened is that stock market didn't even crash. In fact, it rallies all the way from January until now, which you can see from the Nasdaq chart that I shared earlier. In fact, the January of 2023 was the bottom. It just moved up and up. And of course, a lot of people who were betting on recession, right, got it wrong during that period and lost a lot of money. But nonetheless, right, we were still able to make some money along the way, and currently this is our return. And hopefully going into the fourth quarter, we will be able to get another 10%, 15%. Hopefully we can hit like 50% for 2023, which is our usual average. So our take on the current stock market. from a trader perspective, our analysis is that the US economic indicators suggest market will continue to be resilient for the remainder. Sorry, a few spelling mistakes for the remainder of 2023. Not reminder. But we are cautiously bullish lah. Okay, cautiously bullish as in we are not going all in, everything buy, that kind of stuff. We are buying a bit here, a bit there, but we are not overexposed. And when we are actually buying stocks, right, we are targeting specific companies within the consumer sector where consumer spending is still strong now, okay? Because as you can see just now, consumer spending is still very, very high. So we are targeting specific sector where all these spendings are going into, and companies that are also seeing good revenue growth and good earning growth lah. So we are also bullish on alternative energy sector due to the Inflation Reduction Act. However, right, not every sector is strong, so you have to be a little bit picky on what kind of stocks that you are trying to buy. In fact, some of them are starting to show crack and weakness lah, okay? So, although we are bullish, we are actually building up a watch list of potential short trades when the economy eventually breaks. So we actually have a very long watch list of a lot of companies that we are looking to short sell in order to make money if they happen to crash. So we already prepared this ready. So we are just playing a bit of long position here and there. And then if eventually market crash, right, we will throw in all our short position lah. So we are, for the short targets, we are actually targeting sector that will break first from the high interest rate. For example, the home builders, the commercial real estate, and any company with very high level of debts. So the timing will be quite tricky because we don't really know when market will crash also. It can be in Q4, it can be in Q4, it can be January next year, or it can be like 2025 also. Nobody knows, okay? So traders, investors, we are not here to predict stuff lah, okay? But we are just here to look at the data, and then based on what we are seeing, we will adjust our portfolio accordingly. So because the timing is very, very tricky, right? We are not overexposed to the bullish side, meaning to say that, let's say I have $200,000 in capital, right? I'm not going to put all $200,000 in Apple or Nvidia. I will actually hold some cash or hold majority cash, or I will even start short selling certain companies lah, that are already looking quite weak. So whatever you do, right? Whatever you do, do not all in, okay? Do not all in on either side. Do not all in go and buy, or do not all in go and short. Because firstly, if you go and all in buy and the market crash like next quarter, you will lose a lot of money. But if you all in go and short like Michael Burry like that, then what can happen is that market continue to be resilient, and then you lose money on your short position lah. Okay, so whatever you do, do not all in. So these are some of the companies that we are actually bullish on. In fact, some of the stuff here we have actually traded in our private community for the subscribers. But a disclaimer here, this is not a trade call, okay? Don't go and after today's session, go and buy all this stock, and then you come and find me 1 month later, say, hey, everything losing money like that. So please do your own due diligence and risk management. So First Solar is our pick for alternative energy. It will benefit greatly from the Inflation Reduction Act lah. And another one that is related to alternative energy is Chemical. Chemical is a uranium mining company where the customers are nuclear energy companies lah, okay? So currently, both solar energy and nuclear energy are like gaining more and more acceptance, especially nuclear energy in the US. So going forward, these two companies, I think they will do quite well lah. And the rest are On Holding. On Holding is a Swiss running shoe company. So this is more on consumer spending lah, okay? So I personally own one of these shoes before, one of their shoes before, and it is quite nice. It is quite nice, but it's very expensive lah, okay? One pair will cost you like $200, $300 like that. But very comfortable, extremely comfortable. The other one is Shake Shack, everybody knows lah, okay? Restaurant. And the last one is Construction Partner. Construction Partner is a US company that does construction on infrastructure, mainly roads. So majority of their customer, right, is actually coming from government spending now, okay? So no matter what, right, be it recession or growth or whatever, right, definitely road construction or road maintenance, right, it have to be done. And since majority of the spending is coming from government sector, right, I would say this is quite defensive sector lah, in a way, because recession or not, I think this company will do quite okay lah. So these are some of the stuff that we may have already traded or we are intending to trade in the future. And companies that we are bearish on. So most of the company here, right, we have no position yet, but eventually when we see the data start to show signs of weakness in the economy, we will start to short these companies, okay? Firstly is MDC Holding. It is a home builder company. So as I mentioned earlier, right, as the interest rate is held at 5.5, 5.75 for like a period of time, eventually all these home builder company, they will start to suffer lah, they will start to crash lah, because there's only so long that consumer can pay, consumer can accept over 7% mortgage rates lah. Once their savings are gone, right, they will no longer accept that rate, and then the demand will drastically drop. The other one is East West Bank. This is a regional bank in US. The reason why we pick out this bank is because firstly, right, this bank have very high exposure to the real estate sector. So the real estate sector, they are very interest rate sensitive also. As the interest rate increase, right, I'm sure you're all familiar with REITs lah, okay? So for REITs, right, the higher the interest rate, the more the lesser their profit, and then the lesser dividend they have to pay out. So this East West Bank, they have very high exposure to most of the commercial real estate in US. And if the commercial real estate fall, right, East West Bank most likely might end up defaulting or might write off a lot of the loans that they give out lah. And another sort of perks to East West Bank is that they have high exposure to China real estate also, which is currently doing very bad right now. The other one is Steel Dynamic. So Steel Dynamic, they manufacture steel, and majority of the steel, the majority of their customer is actually construction sector, the home builder sector, the electronic vehicle, the EV sector. So if the economy start to fall, right, if the home building demand goes down, Steel Dynamic will be affected also lah. And the last one is Expediter. Expediter is actually a air freight company. So if we hit recession, right, it is highly likely that a lot of people will be buying stuff online, go and buy stuff from Taobao lah, buy stuff from, I don't know lah, okay, buy stuff from Amazon. So when consumer spending falls, the demand for air freight will also fall lah. So it is something that we are targeting in the future also. So conclusion, if you are a trader, your 2023 buyers should be on the bull side, but stay cautious and be nimble. Look out for any breakage in the economy, such as higher unemployment rate, consumer spending declining, your GDP forecast start to decline. Once you start to see these little signs here and there, right, then of course stop buying stuff, hold cash for a while. If economy crash, and then you will want to switch to short position already, okay? So be ready to switch to short position if markets start to fall. And the last thing you want to do is average down on your losing longs. Let's say you buy a stock and then market crash. Please don't go and average down, okay? Just eat the loss and then go and short. If you are a long-term investor, your job very simple. In fact, you don't have to do anything now, okay? You just diligently do your dollar cost averaging on your index or unit trust fund or whatever you are doing lah. And of course, avoid going all in at the current stock market price. So maybe you are new to investing, you have no idea what to do, you got a lot of cash, the last thing you want to do is go and spend all your money to buy the stock market right now. Please don't do that. So what you should be doing is try to spread out your buys, okay? So don't go all in. Maybe you can buy a bit now, then 3 months later buy a bit more, 6 months later buy a bit more. Just spread out your capital. Don't go all in at the current market price. And let's say if the market were to crash in the future, for example, if the stock market dropped like 25 to 50% like that, don't be afraid to increase your DCA amount and take advantage of the lower prices, okay? If market crash, let's say 30%, right? Maybe right now you are dollar cost averaging $1,000 per month and market crash. And once the market crash, right, you may want to increase $1,000 per month to $1,500 per month or even $2,000 per month. You want to take advantage of the low prices because eventually when it recovers, right, you are going to profit a lot. And that is what we actually did what I personally did in 2020 when the stock market crashed in COVID-19. I was doing $2,000 dollar cost average on some of my ETF. I increase it to about 2,500, 3,000 like that. And currently it is seeing a very, very good return now, okay? And the last thing you want to do is you do not want to stop investing when market crash. So just because recession, the market crash, right? Don't cancel your DCA plan, your unit trust plan, okay? Because if you do that, it will take very, very long for your long-term portfolio to recover. So that is basically what I have for today. So before I go on to the Q&A session, right? I'm just going to do our usual City Index promotion now, okay? So I am in partnership with City Index, which is a CFD brokerages. So they currently have this offer, and in fact, this offer actually ended like 2 months ago. But because we are in partnership, right? They are willing to sort of continue to extend this offer to us lah. So what is this offer? Basically, if you have an account with City Index, you have to deposit minimum of $2,000. After you deposit $2,000 into the trading account, you make 20 trades. Okay, you make 20 trades. So there's no limit on the amount. You can buy $1 stock, $2 stock, up to you lah. Okay, whatever lah. Okay, you can buy 1 share or $1 stock. That's considered one trade also. And if you successfully make 20 trades, right, you will get $408 as bonus. But please take note that cash can only be withdrawn after 2 months lah. So after you deposit $2,000, you make 20 trades, you got your $408 cash bonus, right? Your money can be withdrawn only after 2 months. Okay, so what I feel is that this is essentially free money because you can deposit $2,000, and as what I've said earlier, right, you can buy the cheapest stock with the minimal cheapest stock, 1 share. You trade in out for like 20 trades. At most you lose like, I don't know, $10, $20 like that, but you will get $408 lah. Okay, the gold tier. So I'm not really going to explain the platinum tier because I don't think we have I don't think any of us here have sufficient sufficient, how do I call it, capital to fulfill the requirement lah. Okay, but if you are interested in the platinum tier, you can come and find me, or you can find the City Index representative lah. So how do you get this offer? Please follow the instruction here exactly. Okay, so if you do anything else, you may not get it lah. First, you have to open a demo account. I have no idea why. It is what they say. You have to open a demo account. The link is here. I will copy and paste this link in Zoom chat right now, but I will also upload this on the Discord channel. Okay, so you can come to our Discord channel, go to CFD by City Index. I will upload it here. Everybody will have access. Wait, let me quickly copy and paste the instruction so that you all can go and see. Okay, okay, first you have to open the demo account with the link there. And after you set up your demo account, right, you proceed to submit your live account application using the following link. Okay, you only get the bonus if you use this link. If you go and open City Index account with like from other website or whatever, right, you will not get the bonus lah, because this link will tell City Index that you are actually opening the account through me, so you will be given the bonus, because this bonus is already not applicable to the public already lah. So after you have done the second step, you submit your live account application, right? City Index representative, Sean. I think most of you who come for this webinar, you will know Sean already lah. Okay, Sean will contact you after the registration to help you with your account setup. So this offer is valid if you go and open the account by this Sunday lah. Okay, this Sunday 11:59. Because as I mentioned, right, officially this offer was over very long ago. If they specifically open for us because I'm giving a webinar today lah. Okay, so if you are interested, please go and set up by like tomorrow or Sunday, but before 11:59. So this is Sean. He will be the one that will help you out with the registration. So I will come back to this slide later. Okay, later you can scan the digital card lah. So any question related to City Index platform, right, do contact Sean. Okay, CFD resources, sorry, CFD resources, if you are very new to CFD trading, you can visit all this link in order to understand about CFD trading more. So I highly encourage that if you do not have CFD knowledge, please read them, because as with trading, right, leverage trading, there are risks involved lah. Okay, so please make sure you understand what you are doing lah. And lastly, this is resource for our Nimbus Capital. Firstly, we have Nimbus Capital Patreon. This is like Netflix like that lah. Okay, you pay a monthly subscription fee. I will share my portfolio. I will share my market analysis every week. I will also share what I am trading every now and then. So you will get access to all this stuff lah. And of course, all the private Discord channel will be available to you also. So our private Discord channel quite a lot of stuff here lah. Okay, all the trades lah, all the discussion, whatever. And you can join our Discord. There are free channels. If you are not a subscriber to our Patreon, you will still have access to the free channel lah. And we update a lot of stuff through Discord. So any future free webinars, right, you will normally see the update done through Discord. We do have a Telegram channel, but we are trying to move away from Telegram to Discord lah, because it's easier to manage. And we also have 3-month course, which we don't do often. Every year we only hold like 2 times. But in 2024, right, going forward, right, I'm cutting down the frequency of the course, because it's a lot of effort, a lot of effort on my end, and I don't really want to spend so much time giving course really, because when I give course, right, my trading performance suffer, because I'm not spending time in my own trade lah. So in the past, right, we have 2 batches every year, but going forward, I will only have 1 batch per year lah. So you can look at the information here. Our current batch is ongoing now. Okay, currently we have a batch ongoing right now, but the next batch, right, highly likely to be in August 2024. So you probably won't see any courses until like 1 year later lah. And we have a YouTube channel also, where we post a lot of our macro analysis and fundamental analysis. And this video itself will be posted on YouTube. It will be shared on Discord also. Okay, so Q&A, 10 minutes. I'm going to put this screen here, so for those who want to get his contact, you can get his contact here. So you can type out your questions. I will tend to it. But if no questions for like 1 or 2 minutes, then I will end this webinar lah, because market open already. I need to, because Nasdaq today dropping like 1% like that. So jialat. AMD dropped 3%, yeah. Don't be shy, okay? If you need to ask something, just ask. I mean trading related lah. Okay, trading related questions. Or stock market related questions. Okay, I'm going to the washroom about 3 minutes, okay? In 3 minutes, I come back, and if I see no questions, right, then I will end the webinar. Okay, folks, Michigan consumer sentiments 67.7. Did it went up or did it go down? did it went up or go down? Okay, I'm going to remove this, huh? What's going on with the Michigan sentiment? Okay, for all the chemical is the only one. So green, oh my god, 40.86 already. For the stock trader who got this, right? You zao already, okay? You zao already. You got double position, which is very good profit already. Extremely good profit. From here, from the original entry to here, right? It's like 28% already. From the second entry to here, it's like 10% already, okay? For all the option folks, you can continue to hold. And let's look at MDC holding. MDC holding also breaking down already. I think this one we should be able to get the downside profit already lah. On holding, not much going on here. We are probably going to get assigned our option going to get assigned. So let it be. I will happily take the assignment. Shake Shack, also one of the few that is green today, but seems to be suffering right now. So we haven't entered this one yet. We will wait and see lah. Spirit Airline recovering a bit. Seems like bottoming here though. Still dynamic. Broke through. It broke through this consolidation. Maybe in future we can retake this short again. But overall, Nasdaq is down quite big. What else is down? Vita Goco down another 6%. Are you? Construction partner, so far so good lah. Construction partner, it broke out from here, is doing quite well. Let's see who's pulling the entire market now. Oh, home builder sector, jialat, everything red. AMD pulling down. Amazon also coming down. Nvidia so must be Amazon lah. Must be Amazon. Minus 2.5%. Wingstop recently also recovered a bit. Where is East West? East West like going sideways here. Maybe this one we can enter already, I believe, but the option market not really that attractive. Expediter a bit flat. Netflix recently dropped a lot. Disney actually doing very well. Disney actually doing very well. I want to buy, but I want to wait for it to come down a bit. Up best also like want to go down like that already. Toy industry, where's toy industry? Our latest trade. Toy industry also doing quite bad. Okay, guys. So I'm going to log off. Thank you for coming. Thank you for attending. Thank you for your support. For the Patreon subscriber, I will see you tomorrow as usual. Have a good weekend. Have a good Friday. Bye-bye.